Hello, everybody, and welcome back to the Finance Zone. Taxes are involuntary fees levied on individuals or corporations and enforced by a government entity, whether local, regional, or national, in order to finance government activities. In economics, taxes fall on whoever pays the burden of the tax, whether this is the entity being taxed, such as a business, or the end consumer of the business's goods. Today, we're going to talk about 7 ways to pay less tax. Make sure you stay till number 1, as you don't want to miss any step. Number 7, employ your spouse. Employing family members, such as a wife, is a simple way for business owners to save tax, in particular, those business owners whose spouse has no other source of income in their own right. However, you can't just pretend that your spouse works for you. They must contribute to the business, and the level of salary you pay must be commercially justifiable. As long as you can tick those boxes, plus you pay your spouse above the minimum wage, you can deduct their pay as an allowable expense from your business profit and pay minimal tax on their income. Number 6, tax advisor. You also need a tax advisor. A good tax advisor knows the details of the tax code. They analyze your books and identify opportunities for you to reduce your tax burden by adjusting your expenses and deductions. Your tax advisor should be in close contact with your attorney, who helps handle any legal issues your business may face. Number 5, use your pension. By using a pension to save for retirement, you'll also avoid paying tax. That's because your pension contributions qualify for tax relief. So if you're a basic rate taxpayer, you'll qualify for tax relief at a rate of 20%. Meanwhile, higher rate taxpayers qualify for tax relief at a rate of 40%, and additional rate taxpayers will get 50%. So pensions are a great way to build up a tax-free nest egg for your retirement. That said, once you start to claim your pension income, you'll have to pay income tax. You should note that the amount you can contribute to your pension is now limited. Number 4, check your tax code. Your tax code is a series of letters and numbers that determine what your personal allowance is. This is how much you can earn before income tax kicks in. Your employer uses the tax code to calculate how much tax should be deducted from your pay. But how many of us actually bother to check our tax code to see if it's correct? Your tax code is made up of a few numbers and a letter. If you multiply the numbers as a whole by 10, that's how much money you can earn before you start paying tax. Meanwhile, the letter refers to your tax status and how that affects the preceding number. The most common letter is L, meaning you qualify for the basic personal allowance. You can find out more about all of this on this page of the HM Revenue and Customs site. Recent research suggested that as many as 1 in 3 people could be on the wrong tax code. You should double-check your tax code each year to make sure you aren't on the wrong one, as you may then be paying too much to HM Revenue and Customs. If you check your tax code and you think there's been a mistake, you need to contact your tax office. Number 3, opportunity zones. An opportunity zone is an economically distressed urban or rural community that has been identified by certain local, state, and federal qualifications. Additionally, localities can qualify as opportunity zones if they've been previously nominated for the designation by the state, a designation and investment program created by the Tax Cuts and Jobs Act of 2017, allowing for certain investments in lower-income areas to have tax advantages. The goal of opportunity zones is to encourage long-term investments, specifically in low-income urban and rural areas throughout the country, and bolster the economy. Not only do opportunity zones offer a chance for investors to earn significant revenues, but they also have tax incentives that encourage investors to reinvest their unrealized capital gains into qualified opportunity zones. The first tax benefit that investors can enjoy is a temporary deferral of inclusion in taxable income. This deferral is only applicable for capital gains that are reinvested in an opportunity fund. Additionally, the deferred gain must be recognized before the opportunity zone investment expires or before December 31st, 2026. The second tax benefit that investors can enjoy is a step up in the basis for capital gains that are reinvested in an opportunity fund. It is important to note that the basis is increased by 10% should the investment in the opportunity fund be held by the taxpayer for at least 5 years. If the investment is held for at least 7 years, then the basis will increase by an additional 5%. The step-up basis increase can help investors exclude up to 15% of the original gain from taxation. The The third tax benefit that investors can enjoy is a permanent exclusion from taxable income on capital gains from the sale or exchange of an investment in an opportunity fund, assuming the initial investment is held for at least 10 years. It is important to note that this exclusion only applies to gains accrued after an investment has been made in a qualified opportunity zone. The best part of the tax break benefit is that invested capital grows tax-free regardless of how much money it makes, but it must be invested in a qualified opportunity zone for 10 or more years. For example, if a $450,000 investment grows to $2 million after 15 years, you would owe nothing in taxes on the gain. Qualified Opportunity Zone funds are a 10-year or more investment, and not all returns will be the same, so spend time to get to know the fund manager well. The tax perks of qualified opportunity zones do not change the fundamentals of real estate, and no one should invest simply to save on taxes. Evaluate the opportunity on its own merits, and if you like it on a pre-tax basis, then you'll love it on a post-tax basis. Number 2, Delaware Statutory Trust. First thing to know, a Delaware Statutory Trust, DST, can be used anywhere in the U.S., not just in the state of Delaware. A DST is a legally recognized trust in which property is held, managed, and invested. DSTs allow investors to pool together their 1031 exchange proceeds into the trust, making it an attractive investment option. Let's make this easy with an example of how the Delaware Statutory Trust exactly works. A house is worth just under $1 million. The current owners bought it for around $300,000. If they were to sell it today and they put that money in the bank, they would have a substantial amount in capital gains. However, they would lose the continued income that's working for them. One of the challenges, though, is that they're tired of the headaches. It's not earning them that much money. It's getting about 2.7% on return per year, which isn't a great return. A great option for people in similar situations is a Delaware Statutory Trust. A Delaware Statutory Trust, DST, is a legally recognized trust seeking to defer capital gains tax, and the trustor is entitled to the beneficial interest in the trust property. The companies that do this basically pull together people who have the same needs, and they all do a 1031 exchange. Number 1, HSA, Health Savings Account. Health savings accounts, HSAs, are like a personal savings account, but the money is then used to pay for healthcare expenses. You, not your employer or insurance company, own and control the money in your HSA. The money you deposit into the account is not taxed. To be eligible to open an HSA, you must have a special type of health insurance called a high-deductible plan. HSAs and high-deductible health plans were created as a way to help control healthcare costs. A health savings account, HSA, offers 3 separate tax benefits that can make saving for healthcare expenses in an HSA a smart choice now and in the future. Pre-tax contributions. A couple having 2 young children. To help save money for health expenses, they switched to a high-deductible health plan, HDHP, to take advantage of lower premiums. Then, to plan for any out-of-pocket expenses such as doctor visits or prescriptions, they opened an HSA available through their employer's benefit plan. By using payroll deduction to fund the HSA, they were able to make contributions on a pre-tax basis, meaning every dollar they contributed from their paycheck is a tax-free dollar added to their HSA. By the end of the year, they've contributed $4,000 to the account. Because their $4,000 contribution is tax-free, this gives them an additional $1,000 in buying power for medical expenses that they wouldn't have had without an HSA. Tax-free earnings. Any interest earned on the account is tax-free, allowing one to keep more money to use for medical expenses if they need it. Even with a modest rate of return, earnings can add up and boost money they've had on hand to cover their out-of-pocket medical costs. And since they don't have to tap the HSA until they actually need it, they can watch their money grow tax-free over time. Tax-free withdrawals. Normally, when you contribute money to a tax-advantaged account, such as a 401k or an IRA, you're expected to pay taxes on the money once you start making withdrawals. But that's not the case with an HSA. When you use your money from the HSA to pay for qualified medical expenses, you're not taxed on the money you withdraw. Thanks for watching. While you're here, go ahead and click on one of these 2 videos on your screen. See you there!